Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so nice to have everyone here. We've got investors from around the world, and it's a pleasure to have everyone here at the group. Today, we are going to be talking about the topic of bonds, and we're going to discuss bonds as an investment, the pros and the cons, and hopefully in this, I'll be able to show you some things that even if you're an experienced investor, you may not have seen before. So one question that I'm sometimes asked is, why should I invest in bonds? People will say to me things like, well, there's inflation right now. Inflation's real high. Why would I buy bonds? And that's a common question. And rather than giving Benjamin Z. Miller's opinion on that, I'm going to talk about a Nobel Prize winning economist, Harry Markowitz. Harry Markowitz, he actually won the 1990 Nobel Prize for Economics. And if any of you have accounts at BlackRock or Merrill Lynch or Bank of America or any of these different brokerage accounts that are out there, the foundation of a lot of their strategies is actually built on Harry Markowitz's work. He added a lot of contributions to what's called modern portfolio theory. And this is a theory on how you allocate assets within a portfolio. But it's a very interesting, even though it's a very complicated system, and even though BlackRock and a lot of these companies, they use all of this and they make it super complicated. When it came to Harry Markowitz, his own personal portfolio, he did it very simply. Once a year, he would do an adjustment to his portfolio, and he would put 50% of his portfolio in bonds, and he would put the other 50% in stocks. And then at the end of the year or the end of the time period, he would look at the portfolio, and if the stocks had gone up a lot in value, he would sell some stocks and he would buy bonds, or vice versa. If the stocks had gone down in value, he would sell some bonds and he would buy stocks. And the reason that he did this, and this is a direct quote, he said, "I visualized my grief if the stock market went way up and I wasn't in it, if it went way down and I was completely in it. So I split my contributions 50-50 between stocks and bonds." Now, with your portfolio, I just ask you to think about it. Think about what percentage of it is in bonds and what percentage of it is in stocks, because I often find investors that are very heavily concentrated in cryptocurrency. They are addicted to that cryptocurrency. And I find that, a lot of them don't have very much in the way of stocks, and it all comes back to the argument about inflation. So let's talk about the history of bonds. So it's a very interesting history, the bonds. They were actually first issued by the Bank of England back in 1694, and this was done to assist in fighting a war against France. So the Bank of England, they raised money to fight the war with Napoleon by selling bonds. And this is a cool picture. I love this picture. This is a real picture this is one of Napoleon's Bonaparte's horses. This is actually a horse called Vizier, and it is in the museum in France. So it's quite a cool picture. You can even see the crown there. So the history of bonds. One of the interesting bonds that exist is what's called a consul bond, and it's a type of bond that has no maturity date. These are bonds that they never have a point where they're paid off. They're supposed to forever in perpetuity pay interest. And there are some very interesting examples because, for example, if we look at the UK government, when they financed World War I debt, they took out about £2 billion sterlings. They issued about £2 billion sterling in bonds. They borrowed $2 billion. And even today, years later, if you go to February 2015, they were still working on paying those off. So some of these bonds can have extremely long terms, and it's very interesting. Going along with this history, one of my favorite stories is about Nathan Rothschild and the Waterloo bond market coup. This is such a great story. So When Napoleon was defeated at Waterloo in 1815, it was a really key moment because there had been a lot of debt that had been taken out to finance the war. And there was a big question about whether France had won or whether Britain had won. And they had issued a lot of UK gilts. This debt was out there, and the value of those gilts tremendously depended on who won the war. So as a result of this, what happened was the Britain won the battle, and the news was traveling back. But back in those days, it wasn't as fast, the news. It was typically carried by horse and rider and message, and it took time to get the word back on who won or who lost. But Nathan Rothschild, he had about a day's notice ahead of people on what had actually happened. And he knew that the UK had won, but he also knew that a lot of people were watching what he did to figure out what they would do. So what he did was he went and he started to publicly announce that he was going to sell, and he started to sell his bonds. And that set off a frenzy where other people that were holding UK bonds, other investors, when they saw that Nathan Rothschild was selling, they thought, oh, I better sell too, because he's a real smart guy. And if he's selling, I should sell. So they started selling. And then this caused even more selling. And as a result, the price of those bonds just collapsed. But the funny part is Britain had actually won. Yet he was selling the bonds like they had lost. And that caused it caused the value to drop tremendously. So then he was able to, with his friends, go and buy up all of these bonds that the others had sold for pennies on the dollar, or on the pound, pennies on the pound. So he was able to buy these up very cheaply. And it's just a great story. And we'll talk about a few other things. So the main relationship with bonds that an investor needs to be aware of is the linkage between the interest rate and the bond price. Some investors, they know that, if the interest rates go up, the bond prices go down. But if you then ask them, well, how does that change if you're talking about a longer term versus a shorter term bond? That's where you can find how much an investor knows about bonds if they can answer that question. So we'll talk about that in the next slide. But people buy bonds, of course, for passive income. Governments issue bonds to finance wars, to pay for projects. And there's also a lot of different categories of bonds. So there's main categories would be just, government bonds. There's also corporate bonds. Corporate bonds always pay more than government bonds. Government bonds supposedly have a zero default risk because the government can just print more money to cover the interest. And in Islamic finance, there is what is called a sukuk bond. And these were actually developed as an alternative to conventional bonds because a lot of Muslims, they don't consider interest to be acceptable. So they have created a type of bond that they call a sukuk bond. There's a few terms with bonds that are important, and we'll go back to the question I mentioned about duration. What happens if the interest rate goes up and you've got a longer term bond versus the interest rate goes down and you've got a shorter term bond? We'll talk about all of that. So you hear the term note also. A lot of times you'll hear people talk about notes. If you hear someone referring to a note and you're not talking about real estate notes, a note could be debt obligation that's usually less than 5 years. But once you start talking about bonds, that's more common that you find that where they're referring to things that have a term of over 5 years. Premium and par is based on, you compare the value when the bond was issued versus how it has changed in the market, if the value's gone up or down. And then the yield is a simple calculation where you take the amount that the bond pays in interest, and then you just divide it by its current price. So if a bond sold for $100,000, it pays $5,000 in interest, the yield's 5%. Now let's talk about duration. And this is something that new investors often burn their hand on when they hear that bonds are safer. They think, well, if bonds are safer, I should buy bonds. I should buy a long-term government bond because I want long-term income. And they can often have a terrible experience when they take pieces of information thinking that they understand how a bond works, and they make a beginner's mistake of buying a long-term bond. So if they buy a long-term bond that's say a 20-year or say it's a 30-year bond, it can have a massive impact on the value of that bond when the interest rate moves. So let's look at it like this. Basically, if a bond has a duration of 5 years and the interest rates were to increase by 1%, the bond's price is going to decline by about 5%. Whereas if a bond had a duration of 5 years and the interest rates fall by 1%, the bond's price will increase by approximately 1%. So imagine it's a 20-year bond. A 20-year bond, if the interest rate were to increase by 1%, the price of that bond would decrease by approximately 20%. So you can imagine how if you're an investor that bought a bond for, say, 100,000, and then the interest rate increased by 1%, and then you go to sell your bond and you find out, well, you can only sell it for 80% of the value you bought it for. That's not a very pleasant thing. Whereas if you had bought a shorter term bond, if you were concerned about that and you just bought a 1-year bond or a 2-year bond, it would have only moved 2%. So the duration is a critical thing to know about. I'm not going to go through calculating duration. I will give the slide deck that has all of that, but it's just a mathematical formula. You can do it with a calculator. It's not hard. But what about rated debt? This is something that is so often getting investors where they make so many mistakes. And I can't tell you how many investors I've known over the years that they basically will do things like they want to listen to what a rating agency says. They just eat up what those rating agencies say because it's easier for them. They don't have to actually do any work. They can just see that the bond is rated. And they can say, oh, well, if it's rated this, I know how to calculate the default risk. I know what to do. My life is easier. But there's a big, big problem with that. The big problem is once you outsource your thinking to a rating agency, you are at the mercy of that rating agency. And that rating agency, it just has people working there. It doesn't have geniuses. Believe me, the people working at those rating agencies are not geniuses. They are just normal people. And if they make a mistake and they don't catch it and they publish that, then a lot of investors, they get burned. And the best example is Enron. Enron, the American energy company, the Texas energy company, Enron. If we go back to the year 2001, Enron's debt was rated investment grade. That means that it's a higher grade. It's not junk debt. It's investment grade. Now, when certain accounting irregularities were discovered, this created a nightmare for those investors where it turned out that it wasn't investment grade, that it was completely on the verge of bankruptcy. And they, on December 2nd, declared bankruptcy. But that rating agency on November 28th, 2001, they were still running around telling everyone, oh, this is investment grade and all of the sheep. I'm not giving those people a hard time. It's hard for them to know if they're busy and they're not looking at their own investments. They ended up buying all of this really bad, all these really terrible deals. And it's a shame when that happens. So it's just really a good idea to always do your own thinking, always do your own investing. And yeah, it may be a little bit more work, but it's better than just assuming that, well, if a rating agency said so, I can just blindly accept it. So par versus premium. If a bond originally has a face value of 1,000, they will quote the price at 100. So that would be when it's first issued. That's called trading at par. Now say that the interest rates move. Let's say that the interest rates go up higher. that is going to make the market price lower. So the face value, it never changes, but the market price is now lower. That would be quoted, for example, at 97. It's trading at a discount to par, or vice versa. Say that the interest rates went lower, which makes the bond more attractive. It's now trading at a premium to par. Another thing that's critical when investing in bonds is to also look at the exchange rate, because a lot of investors, when I talk to them, they'll say, well, I'm getting an 8% rate of return. And I'll say, what currency is it? Is it British pound sterling? And then, they say, yeah, that's in British pound sterling. But if you look at an 8% rate of return that's in British pound sterling versus an 8% rate of return that's in US dollars, and then you factor in the exchange rate, even though they're both paying 8%, both of those bonds are paying 8%, there is a massive difference in terms of the real value that is going on there. Because if you went back towards the end of World War II, in 1945, when the Bretton Woods Agreement was first implemented, at that time, 1 British pound sterling would buy 4 American dollars. And the pound has gotten weaker and weaker and weaker over the years, where as a result, now, if you go to the 1st of January 2023, that same 1 British pound sterling, instead of buying 4 American dollars, it only buys 1 American dollar and 20 cents. And that's how much has been lost. And that's important if you're going to make decisions. Now let's talk about how our bond prices impacted. This is an interesting graphic. We're looking at here the Ukraine USD bond price. And we can see that if we were to go back to January, it was trading at close to 100. Close to 100, a little bit of a discount, but not very much. And then we see that as we get closer to February 24th, and that is when Russia invaded Ukraine, look at what happened to the price of that bond. Before, it was at around 100, and then it slowly tapers down just a little bit. Just a little bit is tapering down. But then you can see right around here, February 15th, that's where it really starts moving. And it starts really going down. The invasion happens, and that price falls all the way down to less than 20. So imagine how that would feel. You've bought these bonds, you think you're going to get long-term income. You bought them at, for example, 90. They're trading at a little bit of a discount. Russia invades. Now they drop all the way down to below 20. I mean, that's a devastating result for an investor. And that's a very interesting thing to look at. Now let's look at the yield. And remember, I talked about how there's an inverse relationship where as the bond price falls, the yield increases, or vice versa. And you can see here that on the 1-year bond right here, look at how much the yield went up. It went up over 200. And that's because the price dropped so much right there. So you could see the inverse relationship. That's a Ukrainian 1-year bond. Let's look at what happened to the Russian government bond yield. So we see in here that the yield was running around here. And then all of a sudden, Russia invades. We go to, this is February 24th, right in here. It jumps up. It jumps up like crazy. It jumps up to, and that's because the price of the Russian government bond is falling. People are saying, I don't want these Russian government bonds. I want to sell them, because they're thinking this is a little riskier than I signed up for. So the yield went as high as 19%. There were a lot of things that were implemented to try to control things. There was capital controls that were implemented. And then the Russian bond prices, if we look at the yield, once again, we're around February 24th, we see the yield jump. Now let's look at something. We're no longer looking at a government bond price here. We're looking at a corporate bond. This is a Russian Lukoil bond price, and we can see cents on the dollar. And basically with this, what we see is that it was trading at a
recording in progress.
It was trading at a premium to par. And then Russia invades on February 24th. There's the invasion on February 24th. The price completely collapses. And then it just, gradually trends back up. So that's very interesting to see. But what about, let's look at the United States. What happened to the US 10-year Treasury yield? So now we're not looking at the Russian bonds. We're not looking at the Ukrainian bonds. We're looking at the US bonds. We're looking at a 10-year Treasury yield. And you notice here, the yield, here's the 24th of February. We've got this line that there's the report coming out that Russia has invaded. Look at this. The yield, it was before it was going up. Now the yield's going down. If the yield on the bond is going down, what it means is that the price has increased. So the price increased of US bonds. So we see the Russian bond prices go lower. We see the Ukrainian bond prices go lower, but the US bond prices actually went higher. Well, what's going on here is capital flight, where you've got people that are selling bonds and they're saying, what other bonds can I buy? Where is a safe place? Where should I put this money? And they decide, I will buy US bonds. That should be safe. And when they make the decision to buy US bonds, the demand for US bonds increases. Now there are more buyers coming into the market saying, I want to buy US bonds. And we all know that as you increase the demand for a product or a service, the price is going to increase. And when the price increases on a bond, the yield decreases. And that's exactly what you see here. It's a great graphic. Okay, so now the interesting thing that we have here is we are looking at a situation where what's going on now, because those original charts that I showed you, they were for back in February 24th of 2022 when the invasion originally happened. But now the Ukraine's government bond prices have increased. They've climbed up 50%. There's been an increase in the price of the bond by 50% in the last 2 months. And what is driving that is creditors are becoming more optimistic about eventual debt restructuring, because when it wasn't clear what was going to happen, nobody wanted the bonds. But now that things are becoming more stable, things are looking better, there is more demand for the bonds. And as a result, some of the people that bought those bonds 2 or 3 months ago, they got a huge win when they bought Ukrainian government bonds. They're talking about a 50% gain in 2 months. So the foreign reserves in Kiev, they're at an all-time high, 41.7 billion, and that's a lot of financial aid coming in from other countries. So another thing that's important, and I'm not going to go through this, but it will be in the slide deck, I'll just mention it. There's also something that you'll hear called a yield curve. And the simple thing is, we looked at some charts that showed yield, but if you get what's called an inverted yield curve, and we've got a positive yield curve, we've got a flat yield curve, and then we've got an inverted one, that is an indicator of recession. So when you see that, it can indicate recession. There's a video here that goes through that. I'm not going to actually spend the time now going through that, but you can take a look at that and you might find it interesting. Once again, why do you buy bonds if inflation? That's one question I get all the time. It's because you cannot guess what's going to happen in the future. There's always inflation going on, and you don't know what's going to happen in the stock market. Despite everybody that thinks that they're a genius, that thinks that they know what the market is going to do, it's very hard to predict the crowd and what they're going to do. And if you guess wrong, you're going to lose a lot of money. Whereas if you hedge your bets, you can do that. I want to also, as a reminder, I would like to ask everyone to please take a look at the chat window in the Zoom. There should be a red icon that says chat. It's over if you go between participants and news share. There's a red icon that says chat. Please click on that, and there should be a link there to the spreadsheet where you can fill in your contact information. And please take the time to put in a little information on yourself there, your phone number, your email, and about your interest in investing or your background. This information you will get a copy of the presentation emailed to you, but also share this with the other members of the group. So it's an advantage to you where you can not only get the other group's members' contact information, they can also get yours, and you can do some networking. And you're welcome to reach out to anyone on the list, and they can reach out to you. So if you're watching this on the internet and you are thinking, that's interesting, I really like what I learned there, that's something I haven't really learned before, get in touch with me. I do offer personal mentoring for people that are just getting started in investing. Or if you're already a pro and you think you already know everything, go ahead and talk to me, and I might be able to show you some things that you haven't seen before. So that is it for the presentation. I'm going to go ahead and stop the recording. There's a few other slides in the deck. I'll just email those to you, but I'm going to stop the recording and then open it up for any questions.